Welcome back. Tonight on Market Pulse, a conversation with Marc Faber, editor and publisher of the Gloom, Boom, and Doom Report and the author of Tomorrow's Gold. Marc manages about $300 million, and he also has provocative views on the U.S. economy, the role of gold, and also where we're going with energy prices. Now, about the future of the United States, not only as an investment haven, but also as a nation of stable political and social structures, Marc Faber is a thinker. He mixes philosophy and history with his investment advice. Marc, thanks for joining us.
Well, my pleasure. Thank you.
First, tell us a little bit about, I know that you've written extensively about your perception of where the U.S. is headed, its economy, as well as its political and social fabric. Tell us, where do you think the economy in the United States is headed?
Well, I think that in general, we reached probably in the U.S. the peak of prosperity in the 1950s in terms of the advance or the advantages the U.S. had compared to other countries. And then, as you know, in the 60s and 70s, countries like Taiwan, South Korea, Japan came up and reduced the advantages the U.S. had and even eliminated some industries the U.S. had. And now, over the last 10 to 15 years, we have the rise of countries like China, India, and Vietnam that, again, are threatening some industries in the United States. In terms of economy, the U.S. pursued after 2001, as you know, ultra-expansionary monetary policies that led to asset inflation, mostly in home prices, but also in equity prices. And that allowed households to essentially gain from the home equity extraction and go and spend. So in terms of spending, which drives the U.S. economy, the economy is doing okay. But you have to see that after 2001, the trade and current account deficit also increased very substantially. And as a result of that, the trend of the US dollar was down.
And do you think that that's going to continue? I mean, what do you say to people that say, well, the Federal Reserve has done very well in raising interest rates in order to curtail the perhaps easy or easier money policies of the past, and that it has, in effect, done very well at preventing a liquidity bubble from bursting? How do you react to that?
Well, I think that the Fed, since June 2004, has increased the Fed fund rate from 1% to 5.25%. But money hasn't been tight, because the definition of tight money is that actually credit debt, credit market volume, or the debt growth slows down considerably. That is tight money. And believe me, when you have tight money, the art market doesn't go up by 27% like in the US last year, and you don't see new highs in stocks, and you don't see new highs in asset markets such as commodities and real estate. So in essence, we haven't had tight money yet, but it may happen in future. And I think we have to distinguish between two economies. You have the real economy, that's the economy of people providing services, ex-financial services, and producing goods. And then you have the liquidity-driven economy. In other words, the Wall Street type of economy, the asset shufflers and so forth. The asset shuffler economy is doing extremely well because we have this excess liquidity in the system. This huge.
But why hasn't it spilled over into the other economy? Why is it that all these investment dollars are there and are available? Why hasn't that leaked into this other economy you described?
It has leaked to a large extent into economies overseas through the trade and current account deficit the United States has. You have trade and current account surpluses elsewhere, notably in China, and essentially in all Asian countries, but also even in Latin America, you have current account surpluses for the first time in modern history. And that has greased these emerging economies largely, and you have capital spending in these countries, such as China, Vietnam, India, and also Latin America. So what you have is here consumption and production is somewhere else in the world, and the capital spending is somewhere else in the world. And the easy monetary policies the US has pursued have actually helped the emerging world the most. and not the United States.
But is that something that is reflected in asset prices of, let's say, U.S. stocks? I mean, do you expect the U.S. stock market to continue to gain new highs while the, as you call them, the asset shufflers are distributing their wealth, let's say, overseas and helping liquidity in places like China, like India, like Vietnam?
Well, some media says, hurrah, the S&P went up 14% last year, but actually, in euro terms, it went up less than 5%, and in gold terms, it went down. And the Dow is at a new all-time high in dollar terms, but is 38% below the peak in year 2000 in euro terms. The euro has gained 60% against the US dollar since 2000. And I mean, I'm not saying that the euro will continue to go up, and I think I'm staying here at a hotel in New York. Compared to, say, some European hotels, I find it actually quite reasonable. It's not a luxury hotel, because I don't go to these high, super rich hotels that cater to the super rich. But say, I find the price level in the US actually quite reasonable compared to the price level in Europe, and I'm Swiss. But I think the price level in Asia is still low compared to the price level of Europe and the US. And so I believe the US dollar will continue to depreciate, but maybe not against the euro and the pound sterling, but rather against the Asian currencies, notably the Chinese RMB. And in the long run, it's very clear the US dollar will keep on depreciating against precious metals.
Well, before we get to precious metals, let me ask you, what does this do to U.S. asset prices? Do you see that U.S. stock prices will continue, let's say, to trade in a range? Do you see that they will increase, or is there some big dislocation that you foresee on the horizon?
Well, that's a very good question. I would say if money becomes tight, then you will have temporary a strong dollar, but falling asset prices in the United States. That will be the symptom of tight money. The Dow going down, the S&P collapsing or going down substantially, the housing market going down very substantially, but then you get a strong dollar.
What would be an example of tight money in your view? Interest rates that are at what level?
Well, the level of interest rates will never tell you whether money is tight or not. Because in Zimbabwe you have interest rates at over 600%, but money is easy because inflation is at over 1100%. So you could have 600% interest rates and easy monetary policies, and you could have, like say in Switzerland, interest rates at maybe 2.5% and relatively tight monetary policy. The level of interest rates won't tell you. But the symptom of tight money is really that credit growth declines, slows down considerably, and that essentially asset markets don't go up anymore.
Okay, in under a minute, let me ask you, does that mean that we're going to see less debt available for the kinds of LBOs that have been taking place? Are we going to see less credit available for those kinds of speculative ventures?
Well, so far it hasn't happened yet. But you see, I have a theory. I believe that rising asset markets actually create additional liquidity. Because let's say if you have a house, it's worth 100, then the value increases to 200. Then you're going to borrow additional money against that house. So in a way, the increase in the price of the house has created some liquidity. And I've observed one point. When markets go up, liquidity increases, and when markets go down, as occurred in April and May of 2006, suddenly liquidity vanishes very quickly because the leverage positions are reduced. And I've seen this also in the Middle East. In the Middle East, the markets are down, say, 60–70% from the peak a year ago. And as the markets went down, they shrank liquidity very quickly.
Okay. All right, Marc Faber, we're going to have to just take a quick break. But when we come back, we're going to talk about gold. We're going to find out what Marc Faber's outlook is for the precious metal and where you should be putting your money. You're watching Market Pulse on Bloomberg. We're back with more with Marc Faber, the editor and publisher of the Gloom, Boom, and Doom Report. Mark, I want to ask you, connect the dollar to gold for us. The price of gold has increased dramatically, but it seems to have stalled. What's your outlook for the precious metal, and has it really increased when you take a look at it in terms of, let's say, another currency, let's say euros or Swiss francs?
Well, actually, I don't think that the price of gold has increased dramatically. We went from, say, $255 per ounce to $730 an ounce. Now we're around $605 an ounce. Say, compare the price of gold to the price of uranium or the price of oil or zinc, tin, lead, and so forth, then obviously gold hasn't performed particularly well. And in the long run, it's very clear that central banks are basically increasing the supply of paper money. And the supply of gold is obviously very limited. In fact, in the next few years, the supply of gold from mines is going to decline modestly. So there's more and more paper per unit of gold, and of course, as a result of that, the price goes up. And I think the price of gold will continue to go up, and probably in future very substantially.
And so do you think that that now is the time for investors to add gold to their portfolio if it's not already there?
Well, I believe that in the next few months we could get quite a severe correction in all asset markets.
Okay, and what kind of correction? I mean, we're talking a correction that is short-lived. Is this something that will have reverberations that will continue for many months? A lot of corrections,
yes,
they seem to
yes,
just be
yes.
overnight occurrences.
I think we'll have to get together again in 3-4 months once the correction has run through the system. My feeling is, on any meaningful correction in asset prices, say gold goes, let's take...
Okay, let's say gold right now around 600 or so.
Yes, let's say we would go down to around 480.
Okay,
from where the big rally started. If gold drops, say, to 480, we're down 20%. That means money has been very tight. And I would imagine that stocks and other commodities and real estate would tumble under those conditions. If gold is at 480, we are almost in depression.
And what would you recommend investors, or what are you recommending investors do in order to guard against that kind of shock?
Well, I think they should actually buy gold, because let me explain. The big move in commodities over the last few years, since 2001, were in industrial commodities, because we had very strong industrial production growth, not in the United States, but in countries like China, India, and so forth. And so the industrial commodity prices have gone essentially through the roof. And if you take a view that liquidity tightens, let's assume liquidity tightens for whatever reason, then obviously industrial production and the economy will slow down, and that won't be very good for industrial commodities prices. But the case of gold would be, if the economies in the world slow down, and if you have declining asset markets, you have the savior, Mr. Ben Bernanke, with his helicopter that will print money like there is no tomorrow. And so then you could get a situation in the world, especially in the United States, where the economy actually doesn't respond to easy money, but you get inflation in the system. And inflation is
because of all the money that's been printed.
Yes, exactly. It could be asset inflation, or inflation in gold, or could be wage inflation, or could be consumer price inflation. But you get some kind of inflation in the system, but the economy doesn't respond. So you have an extreme form of stagflation. And in that environment, you don't want necessarily to be in industrial commodities, but gold will do well, simply as a currency whose supply cannot be manipulated by the central banks, basically.
Okay. When we come back, I want to ask you more about another commodity. I want to ask you more about agricultural commodities, because we talked about precious metals, but the demand for agricultural commodities as well. We're going to have to take a quick break, but when we come back, there's more with Marc Faber on the trend for commodities. Stick around. You're watching Market Pulse on Bloomberg. Welcome back. If you've just joined us, this is Market Pulse. I'm Pim Fox. We're back with Marc Faber, editor and publisher of the Gloom, Boom, and Doom report. Marc, let's move from precious metals. Let's talk about some of the soft commodities, the agricultural commodities. What is your outlook for things like wheat, for soybeans? They've done very well in 2006. Is this going to be a trend that continues?
Well, they've done well last year, starting, say, the month of July. But if you look at prices over the last, say, 200 years, and you compare to wheat and corn prices to the consumer price index or to oil and so forth, they're still extremely depressed. And some people don't believe in it and others believe in global warming. The fact is simply at the present time, the temperature have been rising. Whether that will continue forever and so forth remains to be seen. But once you get the warmer temperature, you get more extreme weather conditions. In other words, droughts and floods and heat waves and cold waves. And the agricultural commodities could, of course, go through the roof if there is a bad harvest. We've seen that 3 years ago there was a glut in orange juice. 3 years later there was a shortage.
Well, we can see here, taking a look at the
yes,
all
exactly.
of last year, orange juice futures up almost 70% in 2006 into 2007.
Now, for the normal investor, it's not so easy to invest in agricultural commodities, but I would say I wouldn't buy real estate necessarily in cities like London, New York, Boston, San Francisco, because real estate here, say in New York, is very correlated to the financial market. The financial industry does well. Okay, real estate goes up. The financial industry goes into a depression, which will come one day, and then obviously real estate goes down. So we're looking for uncorrelated assets. I think the least correlated asset to financial markets is farmland. And I think you should buy a farm somewhere.
A farm. Now, where do you have any idea specifically?
Well, a friend of mine, he started to buy farmland in Brazil in 1982. He paid at the time $20 per hectare. It's now worth $1,200 per hectare, but it's still very cheap by comparison to, say, Europe or the United States. In Argentina, a hectare of farmland sells, depending on the quality, but say for roughly 2,000 to 3,000 US dollars. And so I think that actually farmland is very inexpensive in a world of inflated asset prices.
Okay, all right. Well, we're going to check in. We're going to keep an eye on farmland prices, but when we come back, I want to talk about a commodity that maybe other people can really get into, and that is oil and energy. We have to take a quick break, but when we come back, Marc Faber on energy prices. We'll get his analysis. We're going to be back in 2 minutes. You're watching Market Pulse. Welcome back. We're back with Marc Faber, editor and publisher of the Gloom, Boom, and Doom Report. Marc, tell us a little bit about energy. I know that this is a subject that you've been following closely. What do you think about crude prices? They have fallen under $60 a barrel. Okay, I know you like to denominate things not only in dollars, but in euros and in gold. But, you know, realistically, I mean, the price of crude has fallen. What does that tell you right now? Is this a time for people to be buying crude stocks as well as oil companies?
Well, as you know, the price of oil went from below $12 a barrel in 1998 to July of this year, $78, and we're now at $55, $56. I mean, you can have bull markets and huge corrections. Say, you look at the bull market in equities, 1982 to 2000. In 87, the Dow corrected 40% and then still went up 8 times. Or the gold bull market in the 70s, between December 74 and August 76, gold corrected by almost 45% and then went up 8 times. So crude oil, we went to $78. We were up, say, 8 times. Now we can decline 40-50% to, say, $45. Even $40 is possible. But I can say one thing, in your lifetime you won't see $12 oil again. And the trend is more likely to be on the upside because the demand in Asia is going to double over time. Not tomorrow, but say in the next 12 years or so. Then you have an additional kicker in oil, and this is we have moved into more political instability. In other words, the war cycle has turned up, the tensions are rising, and if anything happens in the Middle East, where essentially still a very large portion of the oil and natural gas comes from, then obviously the price could be in the sky.
What do you make of the correlation between the price of oil and some countries now wanting to be paid for their oil in non-U.S. Currency, in euros, for example? Is that a trend that you expect to continue? Will it have any effect on the markets?
I don't think it will have an effect because, let's say, if I'm Abu Dhabi, I sell my oil in dollars. I can essentially convert it right away into euros anyway. I can hedge the dollar exposure forward and so forth. So that has actually no impact. But I think that where the impact will come from is A, it is quite possible that oil production is peaking out. We don't know for sure yet, but
and then it gets more expensive to get the oil that is already in the ground out of the ground.
One thing is very clear, and that every geologist will agree. They disagree on many other things, but they all agree on one factor, and that is every day the world is burning more oil than new reserves are added. Now, maybe some genius will discover a method that you don't need oil anymore, but as far as I'm concerned, in most countries, oil is still the cheapest energy and the most practical one. And so my view would be that prices are more likely to rise in the long run than to fall dramatically. Having said that, the oil stocks are actually inexpensive because the PEs on oil companies is relatively low.
Why is that, do you think? Is this something that is just a short-term phenomenon? Why are they selling, as you say, at low PEs?
Well, sometimes the market is relatively smart. Maybe the market, the valuation of oils discounted that oil prices would come down somewhat. But in general, I think the oil stocks are actually quite good value, certainly better value than many other companies in the United States in terms of valuations.
If you're talking about oil as for the next, let's say, decade, still the premier energy source, would you be investing in economies that are based on energy? Let's say an economy like Russia that depends so much on oil, on natural gas. Is that an economy that you think is ripe for investment now?
I'm actually quite optimistic about Russia. And I think Mr. Putin is a very smart man. But the market has, of course, gone up very substantially. A friend of mine invested in a fund I was associated with, Faber, in the mid-1990s, and the fund is up 38 times a fund. So, you know, the valuations have gone up quite a lot, and they're in this down cycle of liquidity I referred to earlier on. I think that actually emerging markets could get hit in the next 3 months. So I would be a little bit careful to buy Russian shares now. I'd be also careful to buy Indian and Chinese shares right now.
But you would be interested in purchasing, let's say, oil companies, oil stocks?
Well, I would be, one of my major investment themes actually for emerging economies is real estate. And I think there's a lot of potential in real estate in countries like Russia, especially India, Vietnam, and China.
And what's the connection there with the energy cycle? Is that because?
Well, basically, you see, Russia. If you look at Russia over the last, say, 30 years, in 1985-86, the oil price collapsed. So the Soviet Union collapsed 2 years later. In 96-98, the oil price collapsed. Russia crisis of the 98. Mr. Putin would have no power whatsoever if the oil price was at $12 a barrel. Nor would Mr. Chavez have any power. Nor would Mr. Ahmadinejad have any power. So the Russian economy, no matter what, is very tied into the commodity cycle. And it's not only about commodities, but it's a large portion of Russia's wealth is derived from commodities and in specifically oil.
Okay.
They basically produce 10 million barrels of oil a day. They're as large as Saudi Arabia, with the difference that they can cut production, whereas the Saudis can't do that.
I apologize. We're going to have to cut you off for just a quick second. We're going to have to take a short break. We're going to come back with Marc Faber on investing in Asia. We'll be right back on Market Pulse. We're back with more with Marc Faber, the editor and publisher of the Gloom, Boom, and Doom Report. Now, Marc, before we get to talking about Asia, I want to ask you, right now, where are you putting your money? Where do you think people should be investing right now?
Well, very good question. You see, in the early 1980s, people were convinced that consumer price inflation would continue forever, and nobody dreamt that after having moved between roughly 700 and 1100 the Dow Jones between 1964 and 82, that it would go to 12,000. Today, people are accustomed to asset inflation. They think asset price will always go up. And I think we may be in a situation where consumer price inflation comes back and will have a negative impact on the valuation of assets. So I'm not a great buyer of assets now. And also my observation is, whoever you talk to, the art dealers are bullish about art, the commodity traders about commodities, the bond dealers about bonds, the portfolio managers about stocks, and the real estate guys think that real estate has bottomed out and will go up again.
So what would you do?
Everybody's bullish. Well, I think in this environment...
Or how would you position yourself to wait?
In a selling panic, you should buy, and in a buying mania like we have now, I think the wise course of action is actually to liquidate some holdings.
But to liquidate it into what? Hold dollars,
well,
hold
gold,
euros, gold, and...
Well, I tell you what, I think the yen and some Asian currencies are undervalued. And let me explain you the reason why I'm quite keen on the yen. We have ultra-low volatility. We have the carry trade. So people borrowed yen to buy all kinds of risky assets around the world. Now this carry trade has led to a record short position on the yen. Now if, for one reason or the other, the carry trade goes to end, and this can happen with asset prices falling, say people borrowed yen and bought the S&P, or borrowed yen
because
and
it was
bought the
cheaper
bonds.
to borrow the yen than
yes,
to
exactly.
invest them in dollar-denominated
Now, if
assets.
these assets go down, then obviously the carry trade no longer works. So they immediately will have to rebuy the yen. In other words, they liquidate the positions.
They have to pay back the lenders.
Yes, or if, say, interest rates in Japan went up, or another reason, a lot of Japanese have actually borrowed yen and shifted yen in risky assets such as Vietnam, India, and so forth, stocks. If suddenly the Japanese market, which performed badly last year, it was up only 6% in yen, but it was down in euro. If the Japanese stock market starts to run and offers better opportunities than overseas markets, you get also a reversal of a large portion of the carry trade. So I think to go long the yen, either through call options or just buy outright the yen, is actually quite a good speculation if you believe that sometimes in 2007 volatility will go up. And I'm a believer in that.
Okay, and does that include also Japanese stocks, for example, the Japanese stock market? Would that be a way for people to do that?
Yes, I mean, I don't think that the Japanese market is terribly expensive, and I think the prospects for Japan are actually quite good. But I prefer other Asian markets.
What are some of those other Asian markets? Would you think about Vietnam?
Well,
would you think about India?
We have in Asia 3.6 billion people, and we have a lot of different cultures, and we have the Chinese, 1.3 billion, a billion Indians, and 84 million Vietnamese, and we have Malays and Indonesians, so each economy is slightly different. I happen to think that Singapore is a very good investment destination. The market has gone up a lot, but compared to interest rates in Singapore, stocks are not terribly expensive. And Singapore is a small city of, say, 4 to 5 million people. It's a city-state, sovereign state, that has a very balanced economy and a price level that is much lower than, say, London, New York. Perfect infrastructure.
And when you say price level, are you talking about real estate?
Real estate, cost of living, and so forth.
And so would you be investing in Singapore stocks?
Yes, I have invested in Singapore shares, yes.
How about in countries like Vietnam, for example? Do you think that
we also have investments in Vietnam. The market last year was up 150%. I don't think it's dramatically cheap, but Vietnam has an incredible potential in the long run, 84 million people. They have a very high level of literacy. In other words, 98% of the people are literate, whereas in India, about 40% of the people are still illiterate, and you have a huge poverty. And then in Vietnam, one great advantage, you have a ethnically homogeneous population and you have a population without a religion. It's very positive.
Will they be stealing business, let's say, for manufacturing jobs from places like China? I mean, where is this buildup going to come from?
Well, what we've seen in Asia is when countries develop, like, say, Taiwan, South Korea in the 60s and 70s, they come in at the low end. In other words, they were making shoes, toys, and the garments, and then they upgrade. And so Vietnam is now still at the very low end, but they have some high-tech companies already investing, Intel as an example. And compared to, say, China gets, say, $50 billion in foreign direct investments on a population of 1.3 billion, and India gets about $10 billion this year on a population of 1 billion. Vietnam will have foreign direct investments of about 8 billion this year on a population of 84 million, so it's actually very significant foreign direct investments.
What about in Thailand, where you're based? You are favored in Thailand right now?
The stock market in Thailand is inexpensive, but we have some problems. We had some stupid measures by the authorities in terms of limiting foreign investments in portfolio investments.
Mark, I'm going to catch you up there because we're going to take a quick break, then we're going to come back and we're going to finish up on talking about Thailand. I'd like to take a quick break. You're watching Market Pulse and Marc Faber. We'll be back. We're back with Marc Faber, editor and publisher of the Gloom, Boom, and Doom Report. I just want to get your thoughts on Thailand. This is where you're based now. Is this the right time to be investing in Thailand, or should people be waiting on the sidelines?
Well, basically, we had this bombing recently, and I think it may have occurred as a result of some disgruntled former government officials, or induced even by Mr. Thaksin, possibly to discredit the present government, and it may go on. And so we have some political problems in Thailand right now. I think that the market in Thailand has been supported in 2006 by foreign buying, because local institutions and local individuals have been sellers. If the foreigners exit Thailand, then the market will go lower. So I think near term the market will go lower. But I equally think that the valuations in Thailand are very inexpensive. But I wouldn't buy tomorrow. I would wait maybe a couple of months, but the valuations are correct.
Okay, and just finally, your thoughts on where we're headed in 2007. Do you think this is going to be a volatile year?
I think the volatility will go up very substantially, and I think we'll get a setback. The S&P has risen now since July 13th without ever a 2% correction. That is not going to last. We'll get more volatility, and we'll get downside volatility, and then it will be very interesting to see what the response of the Fed will be, whether they'll cut interest rates and print money, and then you get rising asset prices, say stocks in the US go up, but a falling dollar.
All right, well, we'll have to come back and find out whether that actually happens. We hope you come back and tell us about it.
Thank you very much.
Marc Faber.
Thank you.
All right, thanks to Marc Faber, the editor and publisher of the Gloom, Boom, and Doom Report, and the author of the best-selling book, Tomorrow's Gold. Tomorrow, well, we'll take a look at financial stocks that should do well in a soft landing scenario. Rob Morgan of Janney Montgomery will tell us which names he thinks are a bargain. Then, if you want to bet on the potential of intellectual property, there's a way you can do it. We'll find out from Jim Malachowski on a stock index that tracks IP-heavy companies. Until then, thanks for watching Market Pulse. I'm on Bloomberg. I'm Tim Fox. Good night.